Do you ever feel like your mortgage is a life sentence? You are not alone. For many Seattle homeowners, paying off the mortgage is a dream that feels just out of reach. But what if I told you it's actually possible to shave years off your loan and save tens, maybe hundreds of thousands of dollars, depending on how much you borrowed in interest? Well, that's what we're going to do here today. I'm Realtor Emily Cressy with HomeProAssociates.com. And as both a realtor and an investor here in Seattle, I have seen what happens when smart homeowners take control of their mortgage. So let's talk about 10 powerful strategies you can start using right now to pay off your mortgage early and retire with peace of mind. Strategy number 1, make bi-weekly payments. This one's easy and effective. Instead of making one mortgage payment per month, split it in half and pay every 2 weeks. That gives you 13 full payments per year instead of 12 without feeling the pinch, especially if you get paid bi-weekly. That one extra housing payment per year could save you over $35,000 in interest on a $350,000 loan and knock 4 years off your mortgage. Do you want to see your numbers? I have linked to one of my favorite mortgage payoff calculators down in the description. So be sure to check that out and you can figure out exactly what strategy is going to work best for you. Next, it's going to be to add extra principal to your payment every month. You can keep your regular payment schedule, but add a little extra money to your principal each time. For example, if you had a $1,670 monthly mortgage payment and you added $140 per month, that's less than 10% extra, you would get one extra payment per year. If you could add $200 per month, you could save $52,000 in interest and pay off your loan 5.5 years early. And bonus tip here, you can turn this on or off anytime depending on your cash flow. So if you are strapped for cash for whatever reason, you don't have to do it. But when the money is good and things are calm, then you can work on paying down that mortgage early. It gives you tons of flexibility. Number 3, this is a funny one. Okay, don't overbuy in the first place. Just because the bank says you can qualify for a $900,000 loan doesn't mean you should take it. If financial freedom is your goal, you need to buy below your means. You'll have a smaller home and a smaller home loan and a faster payoff. Also, downsizing, if you're in like a big family house and you're thinking about retirement in the future, if you sell now and move into that smaller house sooner rather than later, you may have more cash flow, and then you can use that to pay down and eliminate your mortgage years sooner. Sometimes the smartest upgrade is actually a downgrade. Strategy number 4, make a one-time lump sum payment. If you ever get a bonus at work, a tax refund, an inheritance, a big Christmas present, we all wish for that, right? Just put it toward your principal. Paying off like $20,000 early in your loan could save you over $42,000 in interest and chop off 3 years of payments. This one can change your whole financial timeline, and it's money that you just found and you don't need, and you can put it to good use right away. Okay, number 5 has to do with increasing your income. Have you ever gotten a raise, a side hustle, gotten some rental income? Treat that extra income like found money and throw it at your loan. Seattle homeowners are using Airbnb rentals, freelance gigs, YouTube, like making videos like this, right? You could do that. Store boats on your land, RV rentals, rent out that RV that you bought during COVID and let somebody else drive it around and pay you for the privilege, right? You can do all sorts of different creative things to pay down your mortgage faster, and you don't have to change your lifestyle. You can just change where you direct the extra money. Okay, so now I'm going to give you a bonus tip about when not to pay down extra on your mortgage. And before we get to the last 5 mortgage acceleration tips, let's talk about whether that's really a good idea or not. Maybe it's not the best thing for you to be doing right now. For example, if you have credit card debt, if you have no emergency fund, or if you're missing out on like retirement savings, 401k matches, pause your mortgage paydown plan. Just pay off your mortgage on the regular schedule and put the extra money that you may have toward those other higher priority items. It does not make sense to pay down a mortgage with a 4% or a 6% interest while you're carrying a 20% interest rate credit card balance. All right, so now strategy number 6 here. Let's cut your expenses. Every dollar you cut from your budget is a dollar that you can redirect to your mortgage. So cancel unused subscriptions, all those extra TV channels that never have any good shows on anymore. Limit the amount of Starbucks you're drinking. Don't get that cell phone upgraded this year. Instead of going to restaurants quite so much, bring a lunch from home. It all adds up and it helps you buy your freedom back sooner. Strategy number 7, credit card rewards. Okay, proceed with caution. Tread carefully. If you're already disciplined with your credit cards, you can do this. You can put your regular spending on a 5% cashback credit card program, redeem your rewards for cash, and then use that cash toward your mortgage. But only do this if you're paying off your balance in full every month. You don't want to charge extra or spend extra just to get the points. Okay, it's not a good ROI. Number 8 is create a monthly budget. Budgets aren't just for working on spreadsheets. They're also for working on your mind, okay? They're awareness tools. They're going to help you track and become aware of your spending. Set a goal and reward yourself when you stay on budget with a bonus payment to your loan. The more intentional you are with your money, the faster that mortgage shrinks. A lot of people have told me that by doing a budget, they save about 10% of their income more than they were before because they're just being more intentional with what they're doing. Okay, strategy number 9 is to eliminate your PMI, your private mortgage insurance. So when you bought your property, if you put less than 20% down as a down payment, most people in Seattle put 5% or 10% down, then you're probably paying private mortgage insurance, which can cost $150 to $300 a month. And that money goes straight to the bank as a fee or insurance for them. It doesn't actually bring you any value. Okay, so you can get rid of it once you have 20% equity in your home. So you can see as your property is increasing in value and your loan is getting paid down, once you have a 20% equity position, you can get rid of the PMI. And what I would suggest is once you have gotten rid of the PMI, just call your bank and tell them it's time and you'd like to get rid of it. They should do it automatically, but you might have better numbers than they do as far as the values of changing and the equity building up. You're motivated, they're not. So anyway, once you get rid of the PMI, then use that extra money that you're saving to pay down your principal instead. It's like giving yourself a raise, but it doesn't cost you anything. And strategy number 10 is to stop refinancing into new loans. Okay, refinancing is a great strategy if you want to pull out money, say to buy an investment property or put your kids through college or something like that. But it's not going to help you pay off the loan. If you're refinancing to get a lower rate, that's one thing. You will have to pay the costs of the refinance, which can be like 1% of the loan. So it's not free to refinance. But I typically say if you're refinancing into a lower rate and your savings are going to add up and pay off within 18 months to pay off the cost of that refi, then it's probably a good time to get into a lower rate. But if you're doing cash out refis to pay for things, then that's going to be, obviously you're setting yourself back on paying off your home. If you're refinancing to save on interest, you're actually resetting the clock to 30 years again every time. So you're borrowing a certain amount for 30 years at a certain interest rate, okay? And that early part of the loan is when most of your payments are going toward interest. So that's how people stay in debt for longer and longer and longer. So always check your amortization schedule before you sign on the dotted line and consider refinancing into a 20-year or 15-year loan so that you can save money and continue to reach your goal of free and clear. So if you want to know what your payoff plan could look like, we can run your mortgage numbers together. You can visit me at homeproassociates.com and book a free strategy call, and I will show you how extra payments can impact your loan and whether refinancing makes sense for you and what timeline really that you'd like to be working with. So if this has helped, please hit the like button and share it with someone that you know trying to pay off their home loan. Maybe you can have a contest and do it together. Subscribe for more Seattle real estate financial freedom strategies right here, right now. I'll see you on the next video.